We'll go ahead and get started. I want to welcome everybody to the Central Kentucky AgCredit Basics in Borrowing series. This is a series of Facebook Live programs that we're going to do each Monday at 1 o'clock Eastern Time. We thought under the unusual circumstances we're all living in now and students obviously at home, this would be a wonderful opportunity to put on a series that would help everybody, and especially students or people thinking about borrowing possibly for the first time, where they could join in, learn the basics of borrowing, and you'll have an opportunity to type in any questions that you may have that we'll try to get to. We're going to try to limit our part each week to about 20 minutes to allow time for questions at the end. Let me begin by introducing myself. My name is Joe Goggin. I'm Principal Loan Officer at Central Kentucky AgCredit in our Lexington office. I've been with AgCredit since 1992, going on 28 years. And I have with me today Dan Strayer. If you will introduce yourself.
Hi, I'm Dan Strayer. I'm a loan officer here in the Lexington branch also. I've been here about 2 years. Prior to my current position, I was an examiner with the Farm Credit Administration, which is our arm's length regulator. And then family borrowed money from AgCredit probably before Joe even started here.
Thanks, Dan. And obviously we're having to work under conditions under the current situation with social distancing, so we're trying to, obviously we are maintaining our distance here, and we hope that we don't step out of the frame, but if we do, bear with us. We hope that you'll have an opportunity to learn something here. You know, as lenders, whether you've been doing this for many years like myself or Dan, coming over to AgCredit from the Farm Credit Administration just in the last couple of years, we tend to take for granted sometimes what borrowers know when they're on the other side of the desk from us. And so that's one of the goals that we want to do here today is to, and for the coming next 3 or 4 Mondays, is to let you know what to expect and go over the 5 C's of credit. Lenders, it's always been known as the 5 C's of credit: character, conditions, capital, capacity, and collateral. And we're going to go into those each week, and today we're just going to do an introduction, and then Dan's going to start in on the character section. I want to begin with kind of letting you all know what to expect when you go to the lender for the first time, or even picking out a lender. And I guess first and foremost, the main thing is to pick a lender that you're comfortable with and that is comfortable with you. When you go to your lender, whether it's an organization like Central Kentucky AgCredit or wherever you are, maybe your local bank or another institution, you need to be comfortable with that lender, and they need to get comfortable with you as well. Some information that you may want to have prepared, depending on what type loan you're going to be applying for. Obviously, you're going to need your basic personal information: name, address, phone number, social security number, and we'll get into that when Dan talks about the credit bureau. They'll need that to run your credit. And then beyond that, depending on what type of loan you're applying for, you may be asked to provide a financial statement. And you may be asked to provide possibly verification of income, whether it be in tax returns or from paychecks or W-2 form from the previous year. And all that's dependent upon what type of loan you're going to be applying for, whether it's real estate versus you might just be applying to purchase a car or a truck for the first time. In that situation, you probably don't need as much information. The financial information that you provide, you need to be prepared to have a list of all of your current debts, the current balances, and how much your payments are, and then be prepared to fill out that financial statement listing all of your assets, which includes everything that you own, to fill out the financial statement. And those are things that we'll get into in the coming weeks as we talk about capital and then capacity. And the final thing, again, depending on what type of loan you're applying for, you may be asked to provide a business plan. If you're looking to purchase a farm, for example, that lender is going to want to know what your plan is for that farm. What enterprises are you going to be raising? Grains, corn, soybeans? Are you going to be a cow-calf producer or maybe a feeder-calf backgrounder? All of those are different, and they're going to want to know what your plan is And the main thing with that is do some research and make sure your plan is realistic. Make sure your projections on how many cattle you plan to run or how many acres you plan to grow of corn are realistic for that farm, and your yields on the grains or sale prices for the cattle. Your lender is going to probably know what the market is, and your projections need to be pretty realistic. The bottom line here is don't hesitate to ask any questions, either to your lender when you go in to speak to them or today in the coming months. Use the Facebook Live and type in any questions, and we'll try to get to them at the end. With that, Dan, you want to go into credit bureau?
Yeah, thanks, Joe.
Or character?
So I got the pleasure of getting to do character. In my opinion, character is kind of the hardest one to quantify. Everything else has solid numbers that you can really dive in. Character, really the only number on there is credit bureau. And I'll start off with a little bit of what a credit bureau is and how we look at them, and then we'll go into some of the gray areas of character and what we're looking at and why a lender would care about your character. So everybody's probably heard of a credit bureau. Most people don't know the exact math that goes into them, and to be honest, all of them are a little bit different. You have three main companies that you can check your credit bureau with: Equifax, TransUnion, and Experian. All of them are going to weigh things a little bit different, so I'm going to kind of talk in some general terms, but between the three of them you might see they're based off of 10, 20 points difference between them. But the main things they're looking at is a payment history. That's probably going to be your biggest one. The big thing with payment history is, are you making your payments? Are you making them on time? It'll look and see if they're 30, 60, 90 days late, and each one of those can punish you and drop your credit score. Another one they're looking at is credit utilization. How much credit do you have available to you? Do you have $10,000 available on a credit card or a line of credit? Are you completely tapped out and you're maxed out and you don't have any available credit? Those two are going to be the most important. It's probably 2/3 of your weight, and a lot of times credit utilization is kind of a point of time look. Your payment history, that's looking 7 years back, sometimes a little bit more. So it's one of those things. Making that payment on time is really important. The next three, there's really the 5 bases. You're looking at length, how long you have your oldest account, new credit. Are people pulling your credit? Have you bought a new car? Have you bought a new house? What have you done recently? And a credit mix, and that's kind of just the all-inclusive bucket of everything else that could combine of. They're really going to be looking at short-term versus long-term, that kind of stuff. And that's going to be the remaining third. The big thing with length is they're looking at your oldest account, and some people hold credit cards open for a long time, and it can really help. Obviously a home loan will show as your oldest account for if you've been in that house for a long time, but if you pay off your house early or you sell your house and buy another one, that can really affect your credit, and that's something that people don't necessarily think of. Paying off your house, you would think of as a fantastic thing, something to celebrate. But if you've had that account open for 20 years and your most recent account after that's 10, you can take a pretty big hit on it. We'll kind of try and keep an eye out for questions. If you have any, feel free to write them in the chat, and I'll keep an eye on it as we're going. That's kind of the overall basis of credit scores and what we're looking at. Most lenders are really looking at credit scores pretty hard, and a lot of them are using their own credit bureau, some type of program to score, and it's getting larger and larger. Decisions that don't necessarily have a loan officer doing the full analysis, they're just going off your credit score. So it can be very important in the long run. Joe, anything to add?
Well, I was just going to add, something I always tell borrowers, and especially younger borrowers, is it's much easier to start with good credit and keep it there than it is to start with credit that's lower and try to improve. You need to start out as you're building your credit and just make sure those payments are made on time and keep your credit score up, because it's so much easier to maintain it there than it is to try to build it up. If you start out in the hole, you've got a hole obviously to dig out of, and that gets difficult and it takes more time. So it's just much easier to start with good credit and then do the things that you need to do to maintain that good credit instead of trying to improve.
So the rest of these are kind of a gray area. A lot of it's really hard. It's going to be mostly a comparison to peers. But it takes a lot of your loan officer knowing you as a borrower, and really getting a feel for your operation. So we'll kind of go over the generalities, and again, if you have any questions, feel free to throw them in the chat. So again, the main of it's comparison to peers. You're going to look at risk management, and a lot of it will depend on what your operation is. But if there are commodity insurance programs, are you taking advantage of those? Are you doing any risk protection with forwarding contracts or hedging? Is your operation diverse? Are you completely dependent on one revenue stream? Do you have other options? And a lot of that will be, do you follow the market? Do you jump in and out when you have more profit available, or do you stick to your one income source? Production management. Do you use tried and true production techniques? Are you always looking to improve your efficiency? What is your efficiency ratio? And we can get deeper into that when we start talking about capacity. Another one's financial management. Kind of goes back to your credit score. What do your finances look like? Do you make your payments on time? Do you know your operation, what you can service for your debt, or are you just making purchases and asking later, how do I pay for this? Do you have a business plan? And Joe talked about the importance of a business plan, even with borrowing. Knowing what your operation can sustain, knowing what your numbers are, and being able to keep an idea of it. The big question a lot of people will ask is, well, why does my lender care about my character? And a big thing we try and explain to people is character is not necessarily, are you a nice person? Are you is it a popularity contest? We're not necessarily looking at character as you would traditionally think of character. Really, the way we're looking at character is what will you do? How will you react when times are tough? And just seeing how well you know your operation. That's the main of what we've got. If you all have any questions.
No, I'll just add to that, Dan. You're exactly right on character. When we as lenders talk about character, we're talking more of your management ability and even as much as your involvement in. We're an agricultural lender. Your involvement in whether it's the local cattlemen's association or other groups. Lenders, we charge interest on loans, interest rates, and we charge interest for risk, and that's what all lenders do. And so the character is kind of one measure of that risk, and so that does hinge on interest rates, and then we take character and then build to all of the other 4 C's basically after that. And so it is very important, and it's not like Dan said, just our typical are you good old feller type deal. It's more of your ability to manage financially, manage production, agriculture, and your ability to manage difficult times. Not unlike what we're going through right now with commodity prices having suffered dramatically from the coronavirus pandemic. So these are times right here that really measure people's character.
Mm-hmm. Definitely. I think Courtney has questions written down for us. Do you have anything for us?
Yes. The first question is, I have no credit. What should I do?
That's an excellent question, because you got to start from somewhere. There's some easy ways as far as having a cell phone bill on under your name, utilities. You can kind of start off with that early. Even having just a debit card. Sometimes you can open. I hate to tell people that are young to open a credit card, but if managed properly, having a small available credit and make a payment on it. Do it small amounts. Only put so much on it and make sure you're paying it off each month. But long term, that can make a big difference on it. Joe?
No, those are excellent tips, and there are ways that you can build and begin credit, even if like you said, you don't have money borrowed, utility bills or anything like that you can get reported will in fact create your credit, and then you can build on it from there. The main thing, again, I'll go back to is just make sure those monthly payments are paid on time. One 30-day late as you're just beginning to build your credit, one 30-day late payment can really hit your score very hard.
Yeah, and Joe talked about this earlier, but it really is a snowballing effect. As you start building good credit, it's really kind of takes off and starts rolling. You can quickly build from 600-700 up towards everybody's ultimate goal of 800 credit score.
Right.
But it opens up available lines of credit, and you can really add on to it. Courtney?
Another question is, how can I monitor my credit?
You may have more on that. Do you? I mean,
Yeah, there's a ton of different ways. There's a bunch of free.coms. Most people's banks.
Right.
I use my bank will show, and they'll do soft pulls for you, so it actually does not affect your credit. Being able to watch it, and I know not to plug Chase, but they'll show you an update every month for free, and looking at it does not affect your credit negatively in any way. I guess that kind of leads to another thing we didn't touch on: is hard versus soft pulls.
Right.
Those soft pulls are good for you. You know where you're at. You can make sure there's not something that isn't true on there and have to fight it. The other thing is hard pulls. A lot of people worry about hard pulls, but there is a window of when you're shopping for rates and when you're talking to lenders, whether it's for a car or for a house or for a farm, that multiple pulls will associate with the same transaction. So you don't necessarily have to worry about each individual pull when you're shopping for something, as long as it falls within a smaller window.
yeah, and that's what I was going to mention. A lot of times people will start thinking about buying a car or a truck, and they'll go to multiple car lots, and then they'll be pulling their credit everywhere. And one thing I will mention, anytime you go to a lender, they don't need to be pulling your credit without your permission on it. We cannot pull anybody's credit bureau reports without their knowledge and their acknowledgement and agreement for us to do that. So that's just one thing to be cautious of. Don't let anybody be pulling your credit without your consent on that if you find out that they have.
Mm-hmm. All right. Well, unless someone has anything in the chat.